All right, thank you guys so much. I'm really excited for this panel. I'm Casey, I'm a reporter at Blockworks. I'm joined by Tomer from Stellar, we have Rich from Google, Ian from PayPal, and Aadil from Bridge. I guess we'll go ahead and get started. I wanted to start with kind of like a more general overview of the current payments landscape. Aadil, you had a really good analogy that we were talking about in the prep of like where we are and where we're trying to go. Do you want to kick us off?
Yeah, sure. The example I always give for where we are at stablecoins is, I remember I'm from Kenya, and I remember when I went to university in England in 2000, which is a long time ago, and I had an old like Nokia phone, and all my friends were on the same mobile network as me, Orange network, and to send a text message to them cost me 1 cent. But if I wanted to text someone on another network, it cost 30 cents. And if I wanted to text my parents back in Kenya, it cost $3. And so that was just so frictionful to be able to send these messages, to be able to transfer, to be able, especially within the UK, but then also cross-border. And if you look at where we were then and where we are now with WhatsApp, I could be WhatsApping you here, or WhatsApping my mom in Kenya, or WhatsApping anyone, and it's completely network agnostic. And so not only is it faster and cheaper, but it's completely changed the way we've communicated internationally. And I think where stablecoins are going to do the same thing for payments as something like WhatsApp did for communication, where today we are anything cross-border, anything outside of networks where different banks have to talk to each other is really slow, it's really expensive, it's not transparent. Whereas with stablecoins, for me to send my mom $10 in Kenya is exactly the same as sending someone in this panel $10 right now.
Unfortunately, the regulator cares more about money than they care about text messaging.
Yeah, that's true. I think the regulation piece is the most complicated thing for us to solve, and I think we'll dig into that here.
Yeah, we definitely will, but kind of on that challenge aspect. So that's the dream, that's where we want to go. Looking at where we currently are, let's start addressing some of the challenges in the space, what you guys are trying to solve. Ian, do you want to take this one?
So one of the biggest challenges that we're trying to solve is how do we get into a more regulated framework so it's very easy for us to operate. One of the things is PayPal is a very large traditional finance company, and when there's a lot of gray areas within regulation, it's not clear as to how we can go into the market, how we can operate, and what's going to work for us and not work for us. So as a clear regulatory framework gets defined for crypto, it'll allow for a lot more ease of entry, access for the market, as well as clear how we can actually interoperate with other companies, who is working well, who's going to be compliant, and allow us to be able to move faster in the market. So really seeing some of the things that are happening in Congress around the Genius Act, as well as some of the changes that we've seen for SEC do for staking, are really things that we're looking forward to, and it's going to make it much easier for us to interact in the US and around the world.
Tomer, what kind of challenges are you seeing?
Well, I'm actually really excited about the work that PayPal is doing, and they're going to launch PYUSD on Stellar soon, which is awesome. And I think that obviously everyone's going to talk here about the compliance challenges because I came from software. You come to blockchain, you think that it's all about tech. What you learn is that it's all legal, lawyers, and compliance, and that's the state of the world. But I do think that even within kind of like this crypto native world, there's a lot of the speculation use case is still driving a lot of the usage, and there are not enough people actually like building the style of things that PayPal are doing, which is kind of like how do we actually increase the size of the pie, bring in more use cases, bring normal human beings into the mix, and I think we need to see more of that.
From an infrastructure perspective, if we're talking about adoption, getting more users, more use cases, where does the infrastructure currently stand, or what kind of challenges or innovations are we seeing in that space? Aadil, did you want to take that one?
Yeah, sure. So what Bridge does today is we build infrastructure we build payment infrastructure that's all powered by stablecoins. And what we're seeing is more and more utility wants to move on chain, but it's still really, really difficult. Like, it's complicated. Like, navigating fiat to crypto and then across different chains is really complicated. And so what we've decided to do is try and take all these components of like normal payment systems, like what's a savings account, what's a current account, how do I spend this money, and rebuild those primitives on chain. So how do you completely abstract the difference between fiat and crypto and make that really simple? It's the same as a developer. How do you hold balances? How do you earn on those balances? And we have like a prepaid card that you can link to those balances so you can pay. So our view is that as you drive more and more and more utility on chain, by building the infrastructure to support it, you'll see more and more adoption because it'll be easier to build on top of. But I'd be curious what other folks also see.
Yeah, I think one of the important things that has to happen is that abstraction, right, that you guys are talking about, and it's also at the infrastructure layer. So for developers, we spend a lot of time focusing on how do we make it feel like building a Web 2 app, even though you're harnessing the benefits of crypto and a lot of these composable systems and smart contracts. So there's that abstraction layer, which is how do I make a fintech developer who's never touched crypto before, able to leverage the payment rails for building an app in this space. And I think you guys have done a lot of great work there. And I think there is that user experience that Tomer kind of alluded to earlier, which is, most people, when we open our phones and we look at the digital balances we have, right, the wallet is actually really a misnomer. Like when you say you have a wallet, it's actually just a representation of a balance held somewhere else. And this is the power of crypto, is that it is a bearer instrument. In other words, when I open my MetaMask and I see that it's got 1 ETH or 100 USDC, that USDC is in the wallet that private key is holding, that's on my phone and secure. And I think what we will need to do is kind of get people out of the MetaMask era of seeing all these different balances across all these different chains. I have USDC on Stellar and Solana and Ethereum, and just level it up so I see I have 100 USDC. I'm not paying attention to the chains, much like Aadil's example. I'm not paying attention to my cell phone network that I'm sending text messages on anymore. I'm just using WhatsApp. And I think that those two things, they go hand in hand, but I think you need both for this to get really to global adoption.
Yeah, and to add one thing, we're seeing exactly that. Like, most of the developers who are using our platforms, they don't want to see token.chain. They just want to see, I have digital dollars.
Exactly.
And then the user just needs to know, I can use those digital dollars to send it out to whoever I want, and I just trust that it's there and it's fast and cheap and transparent.
I do want to add 2 things here. One of them is the on and off ramp situation, which I think for us here, it's very easy to move in and out of crypto and stablecoins. In a lot of parts in the world, there's a long tail of people that it's very difficult for them. And I think figuring out the last mile is super important. We've done a lot of work in this space with MoneyGram, for example, and you can cash out USDC on Stellar in every MoneyGram agent around the world, which is more than 400,000 locations. So on and off ramps, I think, is a big thing. The other thing, and we don't really have anyone on the panel to address this, is that the regulator is kind of like stuck in the past in a lot of ways. And I think if you look at some of like the draconian regulation around KYC, which we saw with this with the Coinbase issue from a few weeks ago, where so much information got leaked, like we need to be able to utilize a modern technology stack. And I think that Google did a really cool thing with their wallet and kind of like ZK identity, which is awesome. But right now it just gets you into Bumble, which is nice. But what we really want is we want to be able to kind of like allow people to use their identities for like authorized on and off ramps without disclosing, their entire life.
I guess we'll get into regulation now. Everyone's brought it up. We have a stablecoin bill that passed the Senate, the Stable Act, or the Genius Act. The Stable Act's in the Senate, in the House, and the Genius Act might become something similar to that. We'll have to see. In terms of the current policy framework, though, and the regulatory environment, how are you all balancing compliance with innovation? What challenges are you facing? Aadil, did you want to start?
Yeah, sure. The approach that we've taken at Bridge is we're very KYC first. So every single one of our users KYCs, every single one of our business KYCs. And we believe that that's what we have to do to comply with the current set of rules. Our hope is that we will be able to leverage really cool ZK technology and others and make it more appealing for a wider range of people to access these technologies. But for today, we're playing ball with whatever the regulators need. And over time, particularly with the Genius Act, I think for now, our approach is watch and wait and see. We will have time to be able to absorb and react, But for now, let's not overreact to something we don't know the details of over the next couple of years.
Congress is moving uncharacteristically quickly on this, but you're right. We'll have to see how it plays out. I'm curious what you all think too in terms of the current compliance space.
I think for us, and Ian alluded to this earlier, which is the large publicly traded, regulated companies will look at the Genius Act as, again, a very clear line in the sand where they understand the rules of the road and can start engaging, or at least knowing where they can engage and have some reasonable expectation about what type of regulatory regime they'll be subject to. And I think that for a company like Google is absolutely critical. Because for any large regulated business, right, the opportunity cost of taking risk, of navigating in the gray, is a lot greater than a stablecoin startup who doesn't have any other choice but to operate in that gray area. And so if we want to get more large businesses moving into the space and saying, hey, I am going to allow my consumers, my B2B partners to pay me in a stablecoin, I'm going to allow my consumers, to the extent that I'm making payments out to them, right? Think YouTube creators or something like that. If we're going to put that money in their wallet and allow them to receive that, we absolutely have to be clear about what our obligations are so that we can set expectations for our users and our partners, right? And that's a responsibility that you have at a Google scale where you say, okay, we've got 9 products with 1 billion users each. The lack of creating that certainty or expectation is really a problem. And so the Genius Act for us is a really nice line in the sand where we get to say, okay, we know that there are some rules of the road that we have to apply, and we understand how those rules will be applied to us or not. And when we're picking partners or talking about which stablecoins we'll issue, we have a very clear signal about whether or not those stablecoins are or are not compliant. And that's just driven a lot of internal interest now that there's an expectation about what rules apply.
Yeah,
and
Ian,
I agree with everything that Rich just said about the Genius Act. We're really excited about this, and we're watching it very closely. I think this is just going to be an accelerant for the industry because we'll have the rules by which we can go forward and drive adoption. We're seeing a lot of people talk about stablecoins and releasing them, so there'll probably be a little bit of an explosion in the market, just like all the excitement around we're seeing with AI. We'll see something with stablecoins. Then there'll probably be a pullback, and we'll have some clear winners in there. Going back to maybe more of a broader thing around compliance, like Bridge, PayPal is very KYC first. What would be great to see from an overall industry standpoint is just kind of a compliance platform that everybody would be able to plug into, especially startups in the space. Because if we knew that we were working with startups and others that were compliant, it would be much easier for us to onboard and work with smaller companies instead of this really heavy due diligence process that we have to make sure that they're not operating in a gray space that is going to get the rest of the business in trouble. So really excited about some of these things that are going to make really clear operating for us, as well as having a place that as the industry matures to make it really clear as to if you're doing ABC, we can work with you, but if you're only doing DE, we can't touch you, and then we'll just be able to move forward much faster.
Tomer, how do you see regulatory clarity bringing more traditional and centralized companies into the space?
So, Stellar was really built for stablecoins, for RWAs. We have all these compliance features baked right into the built-in assets of the network. So features like allow lists, deny lists, clawback, all of these are kind of like in there from the ground up. So we've been ready and we've been waiting for this. And so I think that we are seeing a lot of just positive signal from folks who were kind of like on the fence are starting to build. I think this might be greedy, but we're already, I think a lot of the folks in kind of like the more yield-generating stablecoins and RWA space we're looking for more answers. And I think that, Stellar really started from stablecoin in payments, but we're seeing this as kind of like a base layer for a completely new financial stack. So if your stablecoins are kind of like your checking account, then RWAs have the potential to be like your high yield savings, and your investment accounts can be DeFi, and all of these need to work together. So getting some clarity around the stablecoin layer is great, but we're already looking for the rest of the stack.
Definitely. Looking more kind of at the payment rails specifically, PYUSD recently launched on Stellar. I'm curious to hear about that process. What kind of opportunities does that open up? Why is it important to have that interoperability?
Well, that's a question for this guy.
Do you want me? I wasn't sure if you're going to go with that first or not, Tomer. So I think it's really exciting because Stellar is in, I think, like 170 to 180 countries. And so giving us that global reach on a chain that is kind of fast and very low cost really gives us the ability to reach a much different demographic than we have with other coins that we're currently operating on. When Ethereum is a little bit more expensive, Solana is fast, but doesn't have quite the global reach that Stellar does right now. So we're really excited to be there, be a partner, working with a chain that's really focused on the payment space and continue to expand the ecosystem.
You mentioned some other rails. Some are not very fast. What are some of the issues? How can we get stablecoins where we need them to be?
Yeah, that's a good question. I think that first of all, like I said, the on and off ramps piece is really big. Obviously, I think there's a lot of stigma on blockchains being slow because of kind of like the older networks there, Ethereum, Bitcoin, etc. And so there's a lot of stigma around that. I also think that a lot of people have seen kind of like claims being made by some kind of like newer blockchains about their response times, and then when you actually submit a payment, sometimes it doesn't go through, sometimes it takes a while, more than the stated numbers. So I think that we kind of like need, like networks really need to have like a fee market that is efficient and that allows transactions to make it through. And we need the whole downstream systems to be able to handle that. So I think especially with like the higher throughput blockchains, it's one thing that your system can handle all of this volume, but there are a lot of downstream systems, indexers, exchanges, payment providers that also need to handle all this information. And so we need to provide them better infrastructure.
Rich, I saw you nod. Or Ian, do you want to go?
No, Rich, you go.
I saw Rich nodding. I'm curious what your thoughts are on how to improve stablecoin speed.
Yeah, well, I think that I agree with everything Tomer said, right? There is a lot of the stigma around, we'll call them, V1 versions of blockchains, and much of the industry, as I'm sure folks here have heard throughout the conference, is really focused on basically making chains that are usable for what are probably the most viral use cases. One of those is definitely payments, right? And so crypto's done a really good job of creating globally distributed infrastructure, composable infrastructure, open source, creating primitives around self-custody, but it's always generally struggled with these issues of how do I create an asset that has significant trust and stability that can be used as a form of payment. Stablecoins solve that. And then the second part is how do I create rails that are globally ubiquitous and can create some sort of deterministic expectation from customers that they will be online and operational and will work as intended, right? Tomer's comment about, we submit a transaction sometimes in crypto and it doesn't go through or it gets rejected, or even just take the idea of gas. Right, gas being paid in a native token is actually like a massive blocker for most consumers. The second you start talking to somebody about stablecoins who's not a crypto person, they get it. They're starting to understand the power of this technology. And then when you say, oh, well, you can't send this because you don't have enough ETH in your wallet and you can't process the gas fees, you've lost most people. And so I think not just transaction speed, but also thinking about how we can make transactions gasless, whether that's at the application layer where somebody's covering that, or by working with chains where the gas fees are essentially de minimis. Those are the other areas that perhaps more than speed are probably things that need to be improved or worked on.
There is one aspect there that I think gets lost often because we hear all of these chains talk about, we do a gazillion TPS, right? And I think that a lot of these statements are obviously nonsense, but the question you really want to answer is not how, what's the throughput that this chain can handle. It's what happens during times of contention. Okay, let's say that CryptoKitties are launching. Let's say the Trump coin is happening on a chain. The question is not how many Trump coin swaps one can handle. The question is what happens to the rest of the traffic on this chain. So if I want to make a PYUSD payment to a merchant, will that get blocked on a Trump coin swap? And so I think that what we're seeing and what kind of like Stellar's concurrency mechanism is really geared towards is kind of like isolating these hotspots, and that's a lot more important than raw throughput.
Yeah, I'll add one thing, and I really agree with what you said about it. It's just so weird for a normal person to be like, I have this digital dollar, and then I got to get this random other thing that has variable price, and it could be 1 cent or it could be $17 based on like network usage of CryptoKitties drop or whatever. I think that's one area we need to solve. The way we do it right now, it's not a great way to solve it, but all we do is just build the developers. We pay the gas, and we build them later. And so it's not taken out of the transaction. The user and the developer doesn't feel it in the moment, but that's not a great solution. The second thing we do is we think about in terms of payments, the difference between detection and finality. So detection means, hey, we detect that this block, like this payment has started. So you can do what you want with that, but know that we'll give you a second webhook when the payment completes. And so there is some risk you're taking of reorg, but some developers and some people will say, that's okay, the probability is like 99.999%, I'm going to take that risk. And so we provide that information, but again, it's still not ideal in terms of the user experience or the developer experience today.
So what everybody really is talking about is experience, and I agree with everybody what they're saying. One of the things that traditional payment systems do is they cheat, right? So when I'm like using my credit card with a merchant, they're paying like 4% for my money, and my car dealership now passes that on to me, and I'm very grateful for them for doing that. But when we're using crypto, the money is there immediately, and when you're dealing with like small and medium-sized businesses, getting that capital on hand immediately is really important because you just don't have the capital that a large enterprise will have or a very large business. And so when we say that it's slow, it's really the experience that is slow, not the access to capital, because credit cards can take up to like net 30 to actually settle and get you your money. And so you have to find other ways to kind of operate your business when you're chunking out the money instead of actually getting it immediately. So a lot of it has to be on this experience from what is the consumer feeling to the gas fees, and how can we make it so it feels just as snappy as kind of using your credit card at a checkout. And once we really get there, I don't know if it'll be just kind of like getting a chain to be like blistering fast or how we've designed the experiences to get it. I think crypto payments will really take off just because of the benefits of getting that capital in the merchant's hands that much faster.
I mean, it goes back to the WhatsApp analogy. People want to be using the technology without necessarily realizing that they are.
They don't need to understand how WhatsApp works.
No, you don't need to understand the
That's the most important
internet.
thing. Like if the requirement was, hey, before you can use WhatsApp, I want to sit you down and talk to you about RPC nodes. Like, no one would ever use it, right? And that I think is the burden is kind of on all of us on stage right now, which is, there's the infrastructure layer, right? There's like kind of what are the Rails doing and how are they built such that developers can leverage this and create delightful experiences for consumers. Then it's, for the folks that are either issuers or, providing the bridges to the banks or even providing the wallets, right? The view should be that when they're accessing a wallet, maybe you let them know that crypto's under the hood, but that's more of like just a, hey, heads up, it's a disclosure. This is gonna go really fast, and if you really wanna know more about it, you can, but right now you just see a balance. And that, to me, is when I think my mom will start using this stuff. And that I think is probably a good watermark for whether or not we've gotten to global adoption.
But hopefully your mom doesn't even know she's using it.
Yeah, that's the goal. Yeah, she just had to be like, oh, my money moves really fast now. And it's like, yeah, well, you're using crypto.
Well, I'm curious with Google specifically. I mean, you're so close to the consumer. How are you all thinking about interoperability between Web 2 and Web 3 and kind of making this more seamless?
Yeah, I mean, honestly, we've stopped kind of thinking about that dichotomy because I was on a conversation with a number of folks across the company about, among other things, new forms of payment, including stablecoins. And we were having this discussion about traditional versus untraditional or novel forms of payment. And I actually had to like kind of stop the conversation and say, wait, we have to actually rethink this question because the people that we say are running traditional payments, banks, the interchange guys, right, Visa, MasterCard, they are all, even Fiserv, they are all playing in the stablecoin space. And a lot of them are using it, under the hood, right? So, there's a consumer element, right? And I know PayPal's done a lot of this where it's, hey, I'm going to give you PYUSD to go and buy goods or services or interact with DeFi. But then there are a number of the retailers and larger businesses that are saying, wait, this is actually like a really clean way to move money. Even just buying between entities within the same corporate family. And so I think that dichotomy for us is really non-existent. I think it's like fun to talk about. It's sort of cheeky, but our view is like stablecoins is about moving money faster. It's not about crypto versus non-crypto. And so when you start to frame it that way, then it becomes well, what does it look like in wallet? Well, it looks like the same way that any other fiat currency should look in wallet. It should show you a balance and be delightful. Well, what does it mean if we accept payment in cryptocurrency or in stablecoins? Well, it should look exactly the same way as if we accept payment in ACH or wire. And once you start to force people to sort of say, stop applying this new framework to crypto just because it's crypto, and start treating stablecoins as if they are just digital forms of the physical dollar in your pocket right now, then people start to say like, oh, okay, yeah, we can do this. This is very easy. And I think that's happening at not just our company, a lot of companies right now, but that's a necessary condition, I think, for corporate executives to get comfortable with this.
There's one thing I disagree with Richie on, which is this idea, the idea that stablecoins are just about making payments faster. I think that the reason I signed up for this industry is all about kind of democratizing access to financial services. So it's not about kind of optimizing in the margins. I think it's really about enabling new use cases, and we're seeing people, in Argentina and Colombia getting access to stable coins and having a US dollar savings, how it changes their lives. We're seeing them go ahead and buy RWAs with that and getting access to financial saving instruments that they haven't had before. So it's really, I know this is the enterprise stage, so maybe this is a bit offensive, but it's really not just about kind of optimizing in the margin.
Yeah, I mean,
I was just going to say, as Tomer was saying about international, one of the things that we're really excited about with PYUSD is being able to use this for remittances. We have to front a lot of money with Zoom, which PayPal owns, to be able to give you access to your cash immediately, and it's very expensive. So by using stable coins as just-in-time funding for this, we'll be able to reduce costs and give the people who are sending money to their loved ones cheaper fees to be able to get that money into their family's pockets. So there's a lot of great use cases for this, and will really reduce the cost of the overall financial system.
Does it also let you reduce the amount of FX float risk you take?
Yes. I mean, that's a conversation we're having. And it kind of ties back into the regulatory side of things, because I think it's very, maybe it's like a cheap analysis that a lot of people in crypto do, where they're like, well, if you just put it in stablecoins, you don't have to worry about capital controls. And that's not necessarily the case either. But for the most part, if you can hold a stablecoin in a jurisdiction where there is a ton of FX risk, it becomes one additional tool in the toolkit that any multinational company is struggling to deal with right now. And by the way, this is becoming more of a struggle as we start to see destabilizations amongst fiat currencies, and just generally chaos, in certain parts of the world. And so that is maybe the icing on the cake is there's hey, this will make it easier for us to send payments, and then maybe we can give more of the dollar to the creator or to the advertiser than we normally would have, because we have cheaper cost of payments. And then there is this other side of it, which is this might actually be more capitally efficient in some ways, or reduce the cost of FX risk.
One thing, we're spending a lot of time with remittance companies as well, and one thing that didn't click for me until I spent some time talking to them was this allows them, right now, many remittance companies have just a relationship with the sender. They don't have a relationship with the receiver. So imagine now, and in many of these countries, the receiver actually wants to store value in dollars. So now what you can do is the sender, they can have a relationship with the sender, they can have a wallet with the sender, it sends it to the receiver then has a wallet that's powered by the same product, and so now they have two customers who they can work with as opposed to just one. There's still some stuff to solve on the regulatory side, but that's a really interesting prospect of how to improve and almost increase the size of the market that remittance companies can work with.
Where I saw you nodding, what's your thought on the current remittance landscape?
So I really like this use case because we're seeing the same thing happen with, so we have something called the Stellar Disbursement Platform, which basically is used to kind of like do batch payments across, we started with like the aid use case in Ukraine a few years ago, and UNHCR is still dispersing it using Stellar and specifically MoneyGram with USDC Stellar. But we're actually seeing basically, instead of giving someone cash, at the beginning, people would just like go and cash out, immediately. But now you actually have people holding on to these stable coins, especially if they want to move cross borders in problematic areas. Then it's much easier to just hold that as a stable coin. We're seeing that happen right now with GIZ, which is this a company based in Germany that manages payroll for the Syrian health workers. They're also now dispersing through Stellar. And that has reduced their kind of like overhead by more than 20%, which is pretty impressive. And a lot of these receivers end up being stablecoin users themselves rather than immediately cashing out.
You mentioned RWAs a few minutes ago. That's such a huge topic in crypto right now. I'm curious how stablecoin liquidity is kind of enabling more RWA transfers. Is there a liquidity issue? I'm curious about that landscape.
Well, you're being presumptuous about the idea of RWA transfers. And I think, I'd love to hear my colleagues here, but overall, what we're seeing is obviously there's an explosion of RWAs. You look at the numbers on RWA.xyz, they're huge. A lot of it is institutional capital and closed loop systems that is not actually moving around. And so I think if the promise of RWAs is providing these type of financial instruments in a way that's inclusive and equal, then we're not quite there yet. And I think we're seeing some progress. So Franklin Templeton, for example, has issued on Stellar. We have close to $500 million worth of their Benji tokens on Stellar. Started out as a complete closed loop system. Now they've actually enabled peer-to-peer transfers, which is great. And I think we're working with them on kind of like enabling it for non-Benji wallets. So we're making progress in the space, but a lot of it is so closed right now. I'm really excited about kind of like some of the new smaller players in the space. For example, this company called Etherfuse that are issuing government debt on various blockchains, Stellar included. They're issuing out of Mexico. The regulator there is kind of like more comfortable with like secondary markets, and so it's actually moving, kind of like plays well with DeFi, and so we're seeing a lot more movements of that with stablecoins, and this is kind of like an interesting place in which like non-US denominated stablecoins are becoming like significant players. For example, in Mexico, you can trade Mexican peso with CETES, which is kind of like this debt instrument in Mexico. So super excited about this. It's still like, if you look at the big pie of RWAs and how much is actually kind of like transferable between normal human beings, it's a tiny amount.
Aadil, I'm curious your thoughts. If RWA transfers become more common, is the infrastructure there, is liquidity there?
I don't think I have anything super smart to say on here, but what we see on the liquidity side is, in most of the countries we work in, there is a net demand for dollars still. And in those markets, for example, let's say importers need dollars to buy goods and services, and remittance companies are sending money to those countries. There's still, even if we're netting and balancing those flows, there's still net demand for dollars. And right now, stablecoins are filling that void, but maybe some tokenized treasury product could fill that void in the future. And I think right now, what we're starting to see is many stablecoins are actually using RWAs to back them. So even though it's closed, we're opening it up, the access to these types of products with RWAs. Like many stablecoins use funds like Barile or Benji or whatever to back them. And so maybe there's a version of the world in the future where we can democratize access to some of these RWAs through stablecoins. And hopefully that could work.
I think it's like on the RWA front, it's interesting because I view it as maybe an evolution or maybe additional complementary less volatile assets besides stablecoins. And what I mean by that is, stablecoins under the Genius Act, it's going to be a one-to-one reserve. So it's hyper safe, right? The idea is this is a bankruptcy remote asset. So if I have the stablecoin and there's some sort of an issue, I'm owed that dollar under the law. And that's really powerful because obviously if we are familiar with just fractional reserve banking, which hopefully we all are if we're in crypto, we understand that that's not how the banking system works. But then there's also things that RWAs are doing that I think are quite interesting, which is taking some of the traditional aspects of the current financial system and saying, well, I can tokenize that and make it so that people can move between a stable coin, a tokenized money market fund, and then perhaps tokenized commercial bank money, which I know we were talking about earlier. And I think there are values to all three of these instruments, and I think they are things that normal consumers or really everyone should have more access to. Under the Genius Act, you can't pay yield on stables, right? But an asset manager can pay yield on a tokenized money market fund. And that's got more or less fixed value and can be shared peer-to-peer on some of these things like Barile and others. And then I think the last part of it is, we do not want narrow banking necessarily in this country where every bank has to be reserved 100%, so you can't get a mortgage. They can't loan out. They can't even offer small business loans. And so a world in which someone can move from hyper-safe stable coins into tokenized money market funds to receive some yield, into perhaps tokenized commercial bank money. I think that's, there's values to all three of those things. And it's more about just kind of creating flows into that. And so companies like Bridge and others who can kind of turn the faucet on will be helpful. But I think they're all equally important. I don't think we're going to end up in a world where everyone is just using stables. I think that's really important.
Yeah, definitely. We only have a couple minutes left, so I wanted to ask everyone, we'll say in the next year, what are you most excited about or most looking forward to in the blockchain payment space? I was going to start with you, Tomer. Are you ready?
Yeah, I'm definitely excited about, basically like payroll in exotic locations. And I think that now with companies like Bridge, with companies like Privy, a lot of the things that used to be chewing glass in our world has become is like slowly being commodified, and I think that we're kind of like ready for this explosion of mass adoption. And I do think that the kind of like the more exotic locations and the more kind of like populations that have been excluded throughout the years are going to see the most benefits.
We're just going down the line. I guess probably no surprise, but I am most excited about companies like Google and our peers becoming more experimental, more aggressive about moving into the space, particularly as it relates to not just accepting stablecoins, but also sharing some of the value of stablecoins with our end users, our consumers, right? People who we pay out on the creator side or otherwise. And I think there's a lot of companies that are looking at that as an opportunity to reach users that maybe they hadn't before. So.
This is going to be a big surprise coming from PayPal, but I'm most excited about more and more payments use cases coming online and the speed of blockchains and seeing how this continues to evolve and being able to accept crypto and use PYUSD for more payment use cases and buying real world goods and kind of bridging between all this value that's locked in crypto, and being able to buy a pair of shoes and everything. So really excited to see a lot of this stuff come online.
And for me, we've touched on this a lot, but it's really abstracting away the complexity of crypto and stablecoins. More and more applications are coming up where you can use them and you just don't know that it's under the hood, but it works really well, it's fast and cheap, and people trust it.
Definitely a lot to look forward to. Thank you all so much.
Thank you.
Thank you.
Thank you.